Today, there were a couple of things that happened specifically to banks in the stock market that made them first go up, and then after the market closed, we saw a subsequent sell-off with the banking stocks. Now, these included looser regulations on what banks can do with their money, such as what they can invest in, how much money they need to set aside for things like derivatives purchases. But then we also saw new restrictions placed on banks by the Fed for things like stock buybacks and dividends. While having more regulations on one hand and fewer regulations on the other hand seem like they are opposing forces, we're going to look at today how these are actually two sides of the same coin. Further than that, both of these things put together point to the fact that the banking industry, the banking system, has had signs of systemic problems wrought underneath the surface going far back before the coronavirus started, with symptoms showing up in the markets as early as September of last year. Let's dive in. What's up, guys? My name is Joe Brown, and this channel is Heresy Financial, and we're going to look at a couple of things today that made the markets move. One of the things that made markets open up and sell off at the beginning of the day was the jobs report. We're not really going to talk about that for this video. What we're looking at is what happened with the banks, because towards the end of the day, news came out that there were regulations being lifted on the banks that would allow them to do things they haven't been able to do in a while, such as have more freedom in what they invest in, like private equity, prop trading, how much cash or margin they need set aside when they do things like investing with derivatives. And that made banks surge. And I'll throw up some charts here one by one. You can see Bank of America, JP Morgan Chase, Goldman Sachs, Citi. You can see these banks all surge throughout the day. Then after the close, we started to see a sell-off, and I'll show you the charts of the same stocks here, just one after another here. You can see that once the market closed, there was a sell-off that started in these stocks, and this was prompted by the Federal Reserve tightening restrictions on banks, specifically in regards to two things: dividends and share buybacks. But before we can really understand why these two things, the tightening of restrictions on one hand and the loosening of restrictions on the other hand, are actually two sides of the same coin, we need to take a little bit of a trip back in time to September of last year. Now, if you remember, September of last year is when the repo market blew up. And the repo market, I've made a couple in-depth videos about this before on my channel, but it's essentially the way that banks get their hands on cash. Now, imagine you didn't have enough cash in your bank account to survive your average day. If you needed to go buy gas or go buy groceries, you don't have enough cash for that, but you have a house, you have a car, you have assets, right? So you could go to your friend and say, hey, I'll let you take my car for now. It's worth, let's say $10,000. You give me $10,000 cash, and I promise that I will repurchase this car from you for $10,000 plus interest in one day or 1 week or a couple of months, whatever the agreement is. You get to hold onto my asset as collateral, and then I promise I'll repurchase my asset from you at a future date. Now, this is the repo market for banks. Banks don't have enough cash to operate every single day. Sometimes they come in underneath what they need. Sometimes they have an excess of what they need. And so banks will operate with each other in the repo market. They'll pledge assets like treasuries, and they'll get cash in return. And in exchange for that, they're promising to repurchase, hence the name repo. It means repurchase that asset from that bank at some point in the future. Well, back in September, the interest rate in this market skyrocketed. And when the interest rate in a lending market like the repo market skyrockets, that means one of two things. Number one, it could mean there's simply not enough cash. Everybody in the system wants to go into the system to get cash, but there's not enough. And so nobody's willing to lend at 1%. Nobody's willing to lend at 2%, 3%. So it skyrockets up to a point where it becomes profitable for a bank to give up their cash, even though they have just a little bit of it. Now, you could also see that interest rate skyrocket for another reason, which would be bad collateral. Let's say everybody in the system has bad collateral. They're not offering treasuries as collateral for cash. They're offering, let's say, I don't know, maybe a mortgage-backed security back in 2008, 2009. And nobody wants to accept this bad collateral because they're like, I don't know what this thing is worth, and so I'm not going to give you cash for it and then hope that you'll be able to repurchase this thing from me at a later date, and I don't get stuck with this as an asset on my books. Now, either one of these is a worry for the Federal Reserve and this system, the fragile banking system that we have in our economy today. And so the Federal Reserve stepped in pretty quickly, and they became the lender in the financial repo market. And so since banks didn't have enough cash to lend to each other, the Federal Reserve did, because they print as much money as they want. So they printed money and they lent it to keep the rates down low, to keep money flowing freely in that market. So obviously this is a sign, a symptom of some things that are not going right in the repo market, especially considering the fact that they said we're not going to release the information about which institutions and banks needed access to cash or needed this collateral taken off their hands. It's not going to be released for a very long time. There is some speculation and some information out there as to who it might have been and who the major players were. A lot of data points to the fact that it might have been relative value hedge funds needing excess cash because of the spread on currencies and treasuries and sovereign debt not being exactly what they needed. But ultimately, it shows that in the financial system, everything is not as it was supposed to be. Now, fast forward to a week ago. Last week, the Federal Reserve started buying individual bonds outright. Instead of just buying bonds through ETFs, they started buying bonds, corporate bonds, individually. Now, this is something nobody is talking about, but the repo market activity by the Federal Reserve has ceased. Since they started buying individual bonds, their repo market activity tapered down over a couple of days to zero. So to me, this looks like evidence that points even more to the fact that there's rot in the system. There's bad collateral that nobody wanted. People in the banking system could see, I don't want these bonds. And so as soon as the Federal Reserve started buying individual bonds, they can start to take these off the hands of bank balance sheets without having to have that repurchase agreement tied to it. They're just buying these bonds. Now, that is one part of a massive system of programs and facilities that the Federal Reserve, in partnership with the Treasury, have unrolled since the coronavirus panic started, which are all ways designed to inject cash into the economy. And the primary way that they try to inject cash into the economy to make business activity stay going is through the banks, because financial activity all happens at the banks. Now, put yourself in the shoes of the owner of a bank. Let's say you run a small bank and all of a sudden the economy looks pretty bad. What are you going to do as a smart business owner managing your business? You've got your bank. Are you going to increase lending during a time when everybody starts losing their jobs? No, you're probably going to pull back lending a little bit. Maybe you're going to tighten the requirements. Maybe you're going to say, if I'm going to lend to you right now, I'm going to require a higher credit score to be able to lend to you. Maybe you're going to say, I'm only going to lend to certain businesses instead of individuals. Maybe you're going to say, I'm only going to make loans with a certain type of collateral attached to the loan, collateralized loans, instead of just unbacked loans. Maybe you're going to say, I'm going to charge a higher interest rate on certain loans to compensate myself for the extra risk in the economy right now. And so across the board, if you're entering into a recessionary period where things are unknown and you don't know how the economy is going to respond to things, you're going to tighten up the ship. You're going to make sure you're not doing anything that's causing your business to have undue risk, considering all of the unknowns in the economy right now. Now, if you're a large bank, your JP Morgan Chase, your Citi, your Bank of America, your Wells Fargo, and you're getting trillions of dollars injected into your balance sheets by the Federal Reserve at the same time as you're tightening lending standards, that's not a very good look. But ultimately, people understand what you and I just discussed. If you put yourself into the shoes of the banker, you're going to say, okay, well, I guess from their perspective, even if you're getting flooded with cash, yeah, you got to get rid of some of the bad assets that you've been wanting to unload for a while. But ultimately, things are still unknown. You're a business. You've got a business to run. You've got profits to worry about. So where is the blame going to land? Is the blame going to land on the banks? Yeah, some of it. But more of the blame and responsibility is going to be laid at the feet of the Federal Reserve and the government. Why are you going to shove all this money at the banks? If they're just going to keep it, they're going to hoard it, they're not going to lend, they're going to tighten up their standards. You're lining their pocketbooks and it's not increasing economic activity. So as the federal government, as regulators, as the Federal Reserve, you're going to look at this and you're going to say, okay, we need to do what we can to make sure that the money we're injecting into the pockets, into the balance sheets of these banks is actually going to make its way out into the economy instead of just lining their pockets. So if I'm the Federal Reserve, I might say, all right, banks, for now, you can't issue dividends. Because we're shoving a ton of money into your balance sheets. Don't just take that and give that to the shareholders. So we're tightening up restrictions on dividends right now. Second, you can't do share buybacks until September. Again, we're giving you lots of money. You can't just take that money and buy back your own shares to make your bank stock go up, to make all of your shareholders happy. You actually have to do something to get that money into the economy more effectively. So what about the deregulation then? Well, this makes perfect sense because the deregulation, the specific deregulation that happened here that was announced today, it loosens the standards on what banks have to hold back in terms of reserves. Now, earlier we already know that for as far as banking goes, they are not required right now to hold any amount in reserves. We call it a fractional reserve banking system because if you deposit $10, historically they could go out and lend $9 of those to somebody else. But now it's a zero reserves banking system, not even a fractional reserves banking system. You give them $10, they can lend all $10 out. And so the deregulation steps that took place today, they were done in order to further that. So specifically regarding investments and trading in derivatives, they loosened the standards on the reserves or the margin that has to be kept on certain derivatives trading. They loosened the requirements, the restrictions on what banks can do in terms of what they invest in, like private equity and hedge funds. Again, these restrictions were lifted in order to say, hey, banks, we don't want you keeping this money just socked away for a rainy day. We want you to be using this and deploying this. And so if we've got rules that are set up in place that are preventing you from getting this money out into the economy, we're going to lift those. Similarly, if we don't have rules in place that are allowing you to just keep that cash in your balance sheet instead of using it, we're going to put some roadblocks in place to prevent you from doing that. So they're two sides to the same coin. Now, I mentioned earlier that the repo market and these loosening of restrictions and adding new restrictions are both designed to inject the money that's being injected into the banks to make sure that that gets into the economy. And that is true, but the second reason that they're doing all of this is because of actual systemic risk that they're seeing with the banks. And in the stress test, the Federal Reserve said today, in doing the stress test, we saw that we needed to make some changes to make sure that the banks could hold up under, potential circumstances that might unfold over the next couple of months. Now, when you read between the lines, this means there are actual problems with the banks. Their balance sheets aren't what they need to be. And so that's another reason for this, not just to make sure the money gets into the economy, but to make sure the banks don't collapse. I've talked about this in other videos, but banks right now, GSIB stands for globally systemically important banks. So a GSIB is any bank that is categorized as being globally systemically important. And especially the European GSIBs right now, banks are extremely over leveraged. There are plenty of banks all around the world that are classified as a GSIB that if they have losses on their balance sheets of 2, 3, 4, 5%, that would be enough to wipe out their entire market cap. Just in case you don't understand what that means, let's say you've got $50,000 in your brokerage account, and that's what you use to trade with. Well, let's say you use that $50,000 to purchase an ETF, let's say SPY, just to buy the market. But you don't just use that $50,000, you buy it on margin. And so you own $150,000 worth of SPY, but only $50,000 of that is actually yours. $100,000 of that belongs to your broker. That means that if SPY has a loss of 30%, you're wiped out. You're zero. You're clean out. If you just trade with your own money, your own $50,000, a 30% loss would mean a 30% loss for you. If you triple up and now you own $150,000, but only $50,000 of that is yours, a 30% loss takes it from a total of $150,000 down to $100,000. You still owe $100,000. That $100,000 goes to your broker first. That's not yours. You get whatever's left over. But that's a 30% loss, which is not unheard of, obviously. We just had March, but it is sizable. But what if that initial $50,000 even wasn't even yours? Now, for the sake of this example, obviously you're not actually able to put money into a brokerage account with a credit card. But let's say you called up your broker. Let's say you called up E-Trade or TD Ameritrade and you said, hey, I'd like to fund my account $50,000. They said, how are you going to do that? You're going to say, I'm going to give you a credit card number. And they say, perfect, fine. Again, you can't actually do this, but for the sake of the example, since we're talking about banks and how over leveraged they can get, it really helps. So you call them up and you say, okay, I'm putting $50,000 in my account. You're putting it in with a credit card though. Are credit cards backed by any assets? No, they're uncollateralized debt. They're not asset-backed debt. Now, in order for you to get that credit card with that large of a credit limit, let's say you had to tell the credit card company, yeah, I've got $5,000 in my savings account and I've got a good job. So they gave you a high credit limit. You use that to put that money in the brokerage account. Then you used your brokerage account. You triple leveraged your entire account. That means that your net worth right now, that your assets, your total assets, your savings account is worth $5,000. You've got $150,000 though in a brokerage account, none of which is yours. $50,000 of that you owe to the credit card company, $100,000 of that you owe to your broker. That means if the stock market goes down by 3.33%, you're wiped out. If you sold everything, you sold all your stock and paid back all your debt, now you have zero. The market went down 3% and your entire $5,000 in your savings account is gone because you needed to use that now to pay back your debt because your asset that you bought with it is worth a lot less. That's the exact position that a lot of banks are in right now. Their balance sheets are so over leveraged that a move in the wrong direction on their assets in their balance sheet by some of them 1.5%, a lot of them under 5%, means that it wipes out their entire market cap. So ultimately at this point, regardless of the intervention, regardless of the new restrictions and regulations and lifting of old restrictions and regulations, there is so much rot in the system that it's almost impossible for there not to be some sort of a banking crisis where banks start dropping like flies all around the world. Now, of course, as this starts to happen, I expect there to be massive bailouts and bail-ins, nationalization of banks, absorbing them into the central banks, and I expect that to happen. I don't really see, especially in the West, especially with some of these globally systemically important banks, for the governments to just decide, we're going to let these banks go under. I don't see that happening. But it will contribute chaos, and it will grind things to a halt in the financial markets while things are getting worked out. So what's the timing on this? A lot of people who are looking at this data and expecting some sort of banking crisis because of all the rot in the system right now are saying, hey, it could happen in a matter of weeks. In 1-2 months, we could start to see banks starting to fall over and hit each other and knock each other over like dominoes and start falling like flies. But as you know, things like this tend to take a lot longer to happen than it usually seems like they should. And so personally, I expect, especially with the commitment to injecting enormous amounts of capital anytime there is a little bit of a sell-off or a little bit of a sign of risk in the markets, with the commitment to injecting new money into the system by the current federal government and the Federal Reserve, I would expect the financial system to really start to grind to a halt and fall apart later towards the very end of this year or early next year. Now, obviously, I am in no position to influence anybody's ideas on what should happen in terms of policy, monetary policy, fiscal policy. Nobody at the Federal Reserve or the SEC is going to be watching this channel, but just for shits and giggles, let's say my ideas were going to be put into place as solutions for what's going on right now in the economy and in the financial system. What would those solutions be? Well, it's pretty simple and it can be summed up with one phrase: let failure fail. Said another way, do not subsidize failure, because what you subsidize, you get more of. If healthcare is too expensive, so you subsidize it, you get more expensive healthcare. If housing is expensive and so you subsidize it, you get more expensive housing. If failure starts to happen with businesses, companies, individuals, households, or banks, and you start to subsidize that, you start to get a lot more of it. Financial institutions and corporations and companies and governments and systems that operate with too much risk need to fail, because ultimately then, once everything is rebuilt, it will be much stronger. Think of it like driving. New laws and regulations about how people can drive, like the regulation to, have seatbelts installed on all cars, that actually increased the number of accidents and injuries and deaths driving when that law was put in place, because it instills a false sense of security. And in the places in the world where there are less driving and traffic laws, where they're more like guidelines, there's a lot more traffic and a lot more people, and it looks crazy. but everybody is such a better driver because of it that your accidents and your deaths are a lot less percentage-wise than you have in places like America. So restrictions and regulations lure everyone into a false sense of security that causes more systemic risk of giant failure overall. Because right now what those in charge are doing with the financial system and with the economy is subsidizing failure. It's like treating a morphine addiction with more morphine. The economy is addicted to subsidy and cheap money and cheap debt, and we're going to OD on this cheap debt as an economy. The solution would be no painkillers, remove the tumor. And I think this is the point that a lot of people don't make enough. If something like this were to happen, the pain would be so extreme that there would be an instant backlash against it. It's political suicide. Can you imagine what would happen if a surgeon came in and said, we have to take out your tumor and you can't use painkillers? That would cause an outrage. To let these systems fail and to let all these businesses fail, there would be massive initial extreme pain, just like used to happen in America when panics and depressions would happen before you had these systems in place to bail everybody out. The Depression of 1920-1921 was called the Great Depression, but it healed itself within 18 months because there was no intervention from above to try and rescue the economy. Compare that with the one that happened 10 years later, where it's now called the Great Depression, and it lasted for decades because of all the intervention that they put in place to try and deal with it. When you let failure fail, it lets the entire system recover, and the system is stronger as a result. But I'm not in charge, and nobody who is in charge is listening to me. So the best thing that we can do, and what I try to do, is understand, hey, this is how things really work. And so I can advocate for the better things to happen, but I can also understand that the better things to happen are not what's going to be put into place. And so we can kind of see how things will unfold. And so we can see there's a melt up in the prices of assets as the value of the currencies drop. We can see that there's going to be things like that happen. We can see that there's going to be failures in the banking system. And so we can prepare ourselves when we're investing accordingly. Thank you so much for watching. If you enjoyed it, please like, subscribe, share. Really helps the channel out. And you guys are the best. Have a great day.